have to act despite imperfect information, but most don't. And that makes taking action in uncertain times the perfect way to separate yourself from the masses who will be destroyed by inflation. If you sit on the sidelines because you're scared of an AI bubble or nervous about a looming recession, you are guaranteed the worst possible outcome. Inflation will quietly eat you alive. You might dodge a market correction, but you will also miss the 10 days when the market surges forward. According to JP Morgan Market Analysis, missing just the 10 best days in the stock market over a 20-year period drastically lowers your overall returns. This is why the common adage is that time in the market beats time ing the market. Don't try to outsmart the market. Keep enough cash on hand that you never need to panic sell, dollar cost average in, and hold a broad portfolio of high quality assets. Doing it that way, you're never going to be a hero on Reddit's Wall Street bets, but you're also not going to go broke. And remember, there's no way to dodge inflation other than owning assets. I want to beat that point to death. Doing nothing is how you end up being part of the middle class that gets yanked down into poverty. Now, there are plenty of people with good ideas on how to handle owning a broad basket of smart assets. I've talked endlessly about Ray Dalio. So here, let me walk you through another incredible investor, Lyn Alden's portfolio strategy. It's what she calls the 3 pillars portfolio. Pillar number 1, profitable, reasonably priced equities. This is roughly 60%. This is your growth engine. Domestic and global stocks with real earnings, strong balance sheets, and a history of rewarding shareholders. Think of companies with 10 plus years of dividend growth and sustainable payout ratios. These are the firms that weather storms and keep compounding. Even in inflationary periods, strong equities with reinvested dividends build wealth. Pillar 2, cash equivalents. This is going to be roughly 10% of your portfolio. This is your defensive buffer. Short-term bonds, tips, or cash equivalent ETFs. These are never going to make you rich, but they're highly liquid and they give you stability and optionality. When recession hits and liquidity evaporates, this is what keeps you safe and lets you buy when others are panicking. Pillar 3, energy, commodities, and hard monies. This is going to be roughly 30% of your portfolio. This is your inflation shield. Energy producers, commodity giants, and hard stores of value like gold, silver, and Bitcoin. These thrive in stagflationary environments exactly like where the world may be headed to right now. When currencies weaken and governments debase, these are the assets that hold or even increase in value. Now, the genius of this approach is diversification and adaptability. Each pillar is designed to excel in a different macro environment, growth, contraction, or inflation. Together, they make your portfolio resilient across cycles. So despite all of the uncertainty that we're all facing right now, don't sit around too scared to take action. If you're waiting for the perfect time to start investing, it's never going to come. There is no such thing as the perfect time. And while you wait, inflation is just gobbling up your purchasing power. The antidote to uncertainty is not trying to guess the future. It's being prepared for any future. As Ray Dalio calls it, you want an all-weather fund. You can't control what happens to the economy in 2026. And for all the noise that people will make predicting it, myself included, the reality is that no one really knows. So unless you plan to make trading your full-time job, come up with an all-weather strategy like Lyn Alden's 3-pillar portfolio and get in for the long term. That way, whether tariffs usher in an economic apocalypse, AI goes up or down, or the economy goes up and to the right, you're protected against the government continuing to do stupid shit and debasing the dollar through deficit spending.